Thank you, Mr. Chairman. I want to first indicate that I strongly agree with the tenor of the questions that we've heard from Senator Corker and Senator Warner with regard to the Volcker rule and those aspects. I think we've covered that thoroughly, so I'm not going to go into that further myself, but I did want to indicate that that's a direction I would have gone into had we not already had a full discussion of that. And I encourage you to take their comments to heart as we move forward. I'm very concerned about how we are moving forward in the regulatory climate right now with regard to the response to things like the J.P. Morgan issues and others. I want to just shift the focus for a minute, and Mr. Cordray, I want to talk to you first. The housing credit market continues to be very tight, and I'm hearing a lot of concern about how Dodd-Frank will reduce credit availability through the proposed rules for qualified mortgage that increases liability and qualified residential mortgage that requires a 20% down payment. I know that last week the CFPB reopened the comment period for the qualified mortgage proposal until July 9th, seeking comments about data that can be used to model the relationship between the borrower's ability to repay and variables such as the consumer's ratio to debt to income. Is it your intention to also convene a small business panel to discuss the impact of this proposed rule?
So thank you, Senator, for the question about the qualified mortgage or ability to repay rule. One of the reasons we did reopen the comment period is that we have recently been able to obtain a significant amount of data from FHFA that gives us a better window into the mortgage market. We're all, I think, quite concerned, and I know all of you are as well, about the direction and trajectory of that market, and this is an important rule in helping shape the future of that market. We want to be clear that we craft a rule that is based on sound data and that does not unduly restrict access to credit, which I think is something we have been hearing consistently from small banks, large banks, community and consumer groups across the country. Even after the Fed's comment period had closed on this proposed rule, we continued to get immense amounts of comment from different groups, and we thought that we would open up a comment period again to make sure everybody had an even chance at commenting on those issues, including data issues that we have identified in the re-comment proposal. Because this rule was originally proposed by the Fed, the small business panel is not implicated, and if we were to try to convene a whole process, we would miss the statutory deadline Congress has set for us, which is January of 2013, which we fully intend to comply with. So that is our approach at the moment. We encourage any small provider that wants to take advantage of the renewed comment period, and this is part of the reason why we did it. Those outside the Beltway often do not understand ways that they can access the agency, and we want them to have full access and full voice in our rulemaking to make sure we're reflecting the entire market.
Well, thank you. And to Mr. Gruenberg, Mr. Curry, and Mr. Tarullo, it would seem to me that because the qualified residential mortgage is supposed to be more broadly defined than the qualified mortgage, would it be correct to say that the banking regulators should wait for the CFPB to finish its rules before they move ahead with their risk retention rules?
I don't know that a formal, Senator, I don't know that a judgment's been made on that. I think as a general matter, we had thought that there was a logic in having the QRM follow the QM. So we'll have to see, but there is a logic to that.
Mr. Curry, do you agree?
I think that's a necessary component to the entire package of rulemaking, the QRM and the QM.
Mr. Tarullo?
It's an interagency process, Senator. If people want to wait, we will wait too.
All right, I'd encourage you to do that. Mr. Tarullo, recent events have highlighted the difficulty in modeling risk. My understanding is that the Federal Reserve is following or utilizing the current exposure method, and that there has been quite a bit of concern about whether that is an accurate method of risk modeling. Are you considering other models, or are you focused on simply staying with the current exposure method?
Sorry, Senator. In what context? In the stress test context, or in the?
Yeah, that's my understanding. Yes.
So with with respect to the stress testing, I mean, what we're trying to do in stress tests is make our best judgment as to what kinds of losses would be entailed across the industry.
Let me interrupt.
I'm sorry.
I was mistaken. I was more focused on the single counterparty.
Yeah. Okay, so that is a different issue, right? That's a calibration issue with respect to the determination of the exposure of a large institution to another institution for purposes of the limits that would be promulgating. So that will be that's one of the topics that's being commented on in the consideration of changes to or potential modifications to the proposed rule on 165, 166. There have been a number of alternatives suggested. I think the challenge, just without trying to signal where we would go, because we haven't seen all the comments yet, and I certainly haven't had a briefing on it, but I think the challenge is going to be, on the one hand, wanting to have a methodology that tries genuinely to track actual risk exposure, while on the other, not becoming dependent on modeling within firms. Because as we've seen in a number of other contexts, dependence solely upon the modeling in firms can lead you astray, particularly because firms, in our observation, tend to be much better at modeling VAR and associated kinds of risk assessments for more or less normal times, as opposed to the tail events that we're trying to guard against. So in thinking about the comments on the proposed rule, we'll have to keep both those issues in mind, trying to hew towards what really are the risks associated with the positions on the one hand, and on the other hand, wanting to make sure that we're not totally dependent on some internal model.
Well, it's another example of where if we model too aggressively one way or the other, we'll get it wrong and create unintended consequences. So I encourage you to get it right and focus on these concerns about the current accuracy of the current exposure method. Thank you, Mr. Chairman.
Senator